Welcome back to the channel. Matt here with Green Bar Trading. Welcome back to another weekly watch list video. I'm going to go over everything that you need to know for the week ahead. Also, what we saw last week. I'm going to go over the CPI report with you guys as well. So hit the thumbs up and let's get right into it. So we're going to start here with the earnings for the week. Big retail week. A lot of retail like Target, Walmart, Foot Locker here. These are all reporting this week. So if you're interested in how the retail is doing, how their inventory levels are doing, you will find out this week. I think Home Depot, Lowe's, they're all reporting. So pretty heavy week as far as earnings go. All right, so that's the earnings there for the week. Let's go into our economic calendar next. Like I say in every video, you need to know your economic calendar. You need to know when the key data times are coming out. They have been moving markets like I have never seen before. And a perfect example was the CPI on Thursday. That move was incredible. So what we have this week, we have the PPI on Tuesday at 8:30. Expect these to move the market. Wednesday retail sales, you have a lot of things coming up here. Jobless claims, every week we have those. That's going to be on Thursday. So just keep an eye on the economic calendar. We post it every morning in our Discord so that we all know and we're all aware of these important times. Last week, this is our sectors, and this is how they did. Technology killed it. Absolutely killed it. The NASDAQ was up a massive amount last week. All those really beaten down stocks really rallied once the bond yields came down a lot, and I'm going to show you guys why the bond yields came down a lot. So that's our performances there on the week. And then getting into the bonds right now, you can see here massive drops. Just huge drops in the bond market. I'm just going to make this a little bit bigger for you guys so you can see it. All right, so here you go. You have the 10-year that just completely dropped off of the face of the earth. And this is after CPI. Keep in mind the bond market was closed on Friday. Okay? So this is all from CPI. How we open up on Monday is going to be very interesting because these moves are not sustainable. You know, the market doesn't go straight up and the market doesn't go straight down. This is straight down. Will there be a little bit of a bounce? Who knows? But just keep in mind, since they were closed on Friday for the Veterans holiday, there could be some real activity in the bond market come tomorrow. So keep an eye on that. Also, the thing that I look at a lot, the 3-month to the 10-year, right? So this inversion of the yield curve has almost always shown a recession in the future. So we're going to keep a close eye on that. Very big inversion happening there on the 10-year and the 3-month. All right, so that's the bond yields. And this is what happens when the bond yields go down. This is just another graph. This is the SPX. This is the S&P 500, up 6% the last 5 days. And you have the 10-year down 9%. All right, they're just moving different, direct inverse correlation. They're just moving totally in the opposite direction. So if you're a bull, you want to see the yields continue to hold under 4% on the 10-year. That should be decent enough to see a sustained rally into the year end. All right, so That's our yields there. And now going into the CPI and why those yields went really went down a lot. These were the numbers. So expected is here in the middle, and the numbers that we saw come in here on the CPI on the left here. So the monthly change here for the CPI was 0.6 was expected. We saw 0.4. Great. That's very good. That means inflation's coming down. Core CPI, this is something that the Fed really looks at. This strips out energy and food. They were expecting 0.5. We saw a 0.3. That's great. It's still, listen, these numbers are still high, but it's showing that inflation most likely has already peaked. On the CPI headline number, 7.9 was expected. We saw 7.7. Very good. Core, 6.5 was expected. We saw 6.3. These were all better than expected numbers, and the market loved it. All right. So when you get numbers like this, and I'll just show you here also on the government website, you can really, I mean, if you're a numbers geek, kind of like I am, I like to look at, where we saw in October those really nice declines. You can go in here on the government website. It's bls.gov, and you can look at it. So right here, 7.7, you can see here the top line number, all items, 0.4, you can see right here for October. And then if you want to go out to the core, it's all items less food and energy. You can see here 0.3 for the month of October and 6.3 right here. And then you can look at October's month and you can see where the best performances came from. And the used cars and trucks has really come on down. So I think the used car market and, just trying to get a car, they're really starting to see weakness as the rates went up. So that's the, CPI report, Consumer Price Index, right here if you guys are interested in really getting into the numbers. So, when these numbers came out and they beat, the thinking is, and the reason the market went up is because, okay, the Fed, what they're doing is working. Inflation's coming down. Maybe they don't have to be so aggressive. You heard in Powell's last FOMC meeting and presser that he was going to be even more aggressive. They're going to have to raise their terminal rates even higher than expected. And he was going on the previous CPI reports and jobs numbers. So if we start to see better numbers come in, then maybe they pause a little bit. And the market liked that, and it rallied. The yields went down. The dollar went down. Everything that you would like to see if you're a bull happened here on Thursday. On Friday, we saw some follow through. Nice day in the markets as well. So let's get right into that now. So we're always going to start here with our compass. This is the S&P 500. This is the SPY. It's the ETF that tracks it. If you want to look at the S&P 500, just type in SPX here in Thinkorswim, and it will give you the S&P 500. Currently closed at 3992, just about at 4,000, a psychological level. Where I see the S&P 500 going is pretty obvious. If we see any continuation this week, it's going to be right here, this 4,100 level, where you can see this clear downtrend. You have the 200 moving average. This is probably where price is going to gravitate towards. And you should see some resistance around that area. We have in the past, so I can only think we will again. Patterns don't have to repeat themselves, but they really like to. So we'll see how strong the market is, and we'll see what happens, like I said, with the yields, with the dollar, and maybe we can get into that area there. So on the SPY, that would be around 407 is where the 200 moving average is sitting at the moment, right here. And then the downtrend line right here. So that's going to be, that's going to be an area right here where, there could be resistance. I mean, look at this from where we gapped up. 373 is where we closed on Wednesday. 373, and we went all the way up to almost 400. That's a big move in 2 days. Very big move, but on very nice volume. So that's a good sign for the bulls, a good sign for maybe that bottoming out process happened. Maybe we're making a series of these higher highs and higher lows on the way up. So that's definitely a good looking chart since October. So October strength, they, been talking about it all over the place, how you can see year-end rally after midterms. Well, we've gotten that, but a lot of that is because of CPI. So the macros can sometimes destroy technicals, right? So just keep in mind, this whole move here is because of the CPI report. All right, so that's the SPY. Get into the Qs right here. Same thing, breaking out over, key levels here at 282, 283, and now it's making a higher high over the 50-day moving average, still down a ton on the year, just about 28%, still down 28% on the year is the NASDAQ. So that's the Qs right there. Looking at the Dow Jones, this has been a total outperformer on the year. Really a lot better than the Qs, the SPY, the IWM, all those. From where we are now to where we opened up the year at, we're only down around 7% on the Dow. Only down 7%. Now, that's not a great year normally, but in a year like this, when your other markets are down a whole bunch, I think the SPY is still down 16%. Not bad. So down 7% on the DIA. Dow Jones broke trend over the 200 moving average. So we'll see what happens here. But we're kind of extended. We're in those overbought levels. So, still be aware of that. But the overall strength of the Dow is looking pretty good. Looking at the IWM, this is the Russell. I have to go back to the weekly chart here to see this downtrend line to the penny, right? To the penny, to the penny, to the penny last week. So each one of these is a weekly candle. This is a nice weekly candle right up into resistance potentially, okay? Downtrend, but it is, it does have sort of like a double bottom here. Nice bottoming out process. We'll see if we can break out on the IWM. But just keep in mind, on the weekly chart, we're going to be running into that resistance around 190, also this downtrend line. All right, let's look at what I think is really some of the most important things happening at the moment and on the year. So the yields we went over. You saw the big drop in yields here. Each one of these candles is a day of trading. The yields dropped on Thursday. The market was closed on Friday. All right. So things are starting to look like they want to roll over. Right here on the US dollar, We started to see it rolling over here. It bounced on trend, came back to this trend line, and then hung around here and just totally sold off after CPI. The dollar coming down is possibly the best thing for equity, for the equity market. When the dollar is too high, corporate earnings, especially done overseas, which most companies do, their earnings really suffer. They take billions and billions in losses. So with that currency coming back on down, that could be very good for companies' earnings, in the future guidance. So there you go. Dollar way down here. Really big move on the dollar and the yields. All right, going into a couple of things. Now, I'm just going to show you some charts here. Some interesting charts of first some ETFs that I'm watching for this week. And XLF, the financial sector, has really been nice, really been strong here. But you can see here, we're coming back into this area, right? So support, resistance, resistance. What's it going to be here? What's it going to be at this point? Are we going to hold up over this level, or are we going to sell on down? Because we've gotten to this 36 before, just about to the penny, and pulled on back. So this is the financials, kind of at the top end of this range bound action we've been in all year. So I would like to see, it's over the 200 moving average for the first time since way back in March. That's a good sign, but it is a very sloping down 200 moving average. So eventually these things get there. So just, keep in mind, bank stocks, financials, they are at previous resistance. So XLF, XBI is our biotech ETF. This has broken out nicely right here from where we called this, sort of showing a lot of strength. If you look at this on the weekly chart, let's go max weekly, you can see there's sort of like an inverse, right? So an inverse head and shoulders. You have the shoulders, you have the head, and then the shoulders, but it is kind of sloppy. It could even be more of a cup with a really wonky looking handle, but it is starting to show a lot of strength. It's making higher highs. It's closing at higher highs. It's holding up these lows. So XBI, going back to the daily chart, it's over the 200 moving average. It's at its highest close here since back in the summer rally. And, I can definitely see this one continuing to climb. Got the double bottom. This is why I like this back here. And we're starting to finally get that breakout of this elusive 200 moving average. Now it's cleared all three indicators. So XBI, just keeping it on watch. XLE is the next one. Looking at this on a bigger time frame. Oops. All right, so this is the weekly chart. You can see here that this is, I had shown this and posted this on Twitter, kind of like a head and shoulders, right? So you have a shoulder here on the weekly, you have a head here, and then you have a shoulder building here. But more important, on the year, right, you're at this double top, okay? So if you're going to do anything, it's going to have to break out. It's going to have to break out of here soon. It is, I do have to say, the last time it went up here, as extended as it was, it pulled back drastically, pretty much immediately. It hasn't done that yet. So looking at it here on the 1 day, it did pull back a little bit, but it's still consolidating. And then CPI, pushed it right back into that. So keep an eye on this. It's either going to be a great time to take profits and short it, or we can see a bigger breakout. So just keep this one on your watch list. It's still one of those outperformers for the year. So you hate to bet against something, but it is up a lot and it is at resistance. And I showed you guys the weekly chart already. So it is at that area. But that being said, we can still break out. It didn't just like fall off a cliff yet, like what we saw back here, a lot of profit taking. So if big investors still stay in it, there's a possibility that it could break out. So that's XLE. A couple other ones, nothing really important, just some things that I'm seeing. Airbnb, to me, looks like it's going to come up to resistance and then fail. That's just what I see here on the charts. Doesn't mean it has to happen, but that's a really big move from the lows here after earnings that I can see some resistance come into play here and then maybe a pull on back. So that's Airbnb. A couple of gap fill potential is Disney. The gap fill is not that much, probably up to about 100, and then you're going to see resistance. And then on Meta, you have same thing after earnings. You have that gap fill potential up to about 130, which would be around this 50-day moving average. So that's possible, but it's already seen a really big move here off the bottom. But this is just a gap fill, something that really likes to happen in the stock market. It always likes to see these gaps fill before a next leg down lower. All right, so that's Meta. And I think that's where we're going to end it for today. So hit the thumbs up. I'll see you guys back on the next one. Take care, guys.